Hi, I'm Dan Reese, Certified Financial Planner and President of Avery Wealth, and I'd like to welcome you to another one of our Question of the Day videos. Today's March 20th, and most people are on pretty much shutdown, staying at home, trying to use it to social distancing, so hopefully this will give you something to watch. It's a little bit better in an educational standpoint than a lot of the things that you see on TV that can tend to bring you down. But our question of the day, we're going to switch over to the presentation mode. I think is something that a lot of people are wondering about. We have had a few questions about this, so let's bust right into it and see what you think. So our question of the day today is, should I stop or reduce my distributions due to the market downturn? So many of our clients obviously are retired, taking monthly distributions for regular living expenses. And so this is a pretty hot topic. Now, I want to start out with, obviously when you have big market downturns, extra things that you are doing, sometimes it might be a good idea to back those off a little bit. But we're talking about your core expenses here, things that you're going to have month to month regardless, right? So what I want to do is I want to start with a little bit about the two core parts of a portfolio. So when you put together a portfolio that's really designed for retirement, there's generally a couple different pieces, right? The first piece is the stock portion, right? And what we know about stocks, and we've seen it clear as can be the last couple of weeks, can have large fluctuations, right? Ups and downs that we all have to kind of go through. One of the things about those ups and downs are when you're making contributions, there's actually can be an advantage to that. So we call it dollar cost averaging, easy for me to say, right? DCA, dollar cost averaging. And all that means is when the stock price tends to be higher, if you're putting in a set dollar amount each month or week out of your paycheck, you tend to buy fewer shares of stock. And when the price goes down, that same dollar amount, say it's $100 a week or something like that, would buy more shares of the stock. So over time, the reason they call it dollar cost averaging is your average price for the shares that you buy tends to be a little lower. So that's a real positive when you're putting money in. And by the way, for those people that are listening that are still saving and working, keep putting your money in. One of the worst times to stop is when the market goes down because your future returns are the highest then. So one of the things that we don't want to do is what we would call reverse dollar cost averaging. So while it's good when you're putting money in to have this advantage, when you're taking money out, it's kind of the opposite. So we end up selling more shares when the price is down and fewer shares when the price is up. So that actually hurts us, right? So keep that in mind. We really don't want to take systematic distributions out of a stock portfolio. And think of it as your growth bucket, right? That's the part of your portfolio that over time really is going to carry the long-term growth that you're looking for. So the other side of the portfolio is the fixed income, right? And that would be things like bonds and cash and that sort of thing. We know that fixed income tends to have smaller fluctuations, doesn't tend to go up and down as much, right? I will tell you, when you have downturns like we've recently had, many times if you have high quality fixed income, really solid government debt, it tends to go up a little more in those times. So it's a really good diversifier. So for dollar cost averaging, it's really not as significant because we don't have these big swings up and down. So it doesn't have as big of an impact as it would on the stocks. It's definitely more secure, although you get less return, right? So there's that trade-off because risk and return are definitely related. And really, your fixed income position helps you reduce the portfolio risk. So that's really important to understand. So first part of this video is just to understand the two parts of the portfolio, fixed income and stocks. So what we're going to go into now is a little bit of an explanation of how those things work together in a portfolio to produce your income and give you some certainty when you have times like this. So let's go ahead and get on to the next slide here. So jumping ahead a little bit quickly. So we're going to start off with just a typical 60% stock, 40% fixed income portfolio, which is pretty similar to what a lot of retirees would have. Some might be a little less on the stock position, maybe 50%, some a little more, but this is a good starting point. So let's talk a little bit about the statistics. 60% stock, 40% fixed income with a 4% annual withdrawal rate. Now, we bring that up because many of you have probably heard us say before that that's a good number to kind of focus on, a 4% withdrawal rate. And we get questions often is, if my portfolio is going to average 5, 6, or maybe even 7%, can I take more out? Well, the reality is the reason the 4% withdrawal rate applies is because we go through times like we're going through right now. And so that takes into consideration both the good times and the bad times. And it also takes into consideration annual increases in distributions just based on inflation. So if you were to do the easy math, if you had $100,000, that's obviously $4,000 per year starting out, but then each year that would be increased by, say, 2% or 2.5% based on current inflation. So what the process here is we're going to distribute from the fixed income side of the portfolio, because remember, that doesn't hurt us as much. It doesn't have that dollar cost averaging or reverse dollar cost averaging issue that we have on the stock side. And if you think about it, at 4%, if we, were in a situation where we were taking, we had 40% in fixed income, that's likely going to provide 8 to 10 years of income without any growth on that side of it, right? Just doing simple math, 4 goes into 40%, 10 years, right? Now, keep in mind, what we do, though, is when there's an up market, like most years, stock markets provide positive returns, we're generally going to rebalance, meaning we're going to take some of that money from the stocks that did well, we're going to sell off those gains and refill that income bucket. But when there's a down market like we're going through right now, that's where we're actually going to rebalance to stocks. And even though it feels pretty painful sometimes, we're actually going to take off some of that extra in our fixed income bucket and move it over into the stocks so we can systematically sell high and buy low, because fixed income traditionally is going to be higher or go up when stocks take a nosedive like they have. Okay, so keep in mind, I've got just a little picture of the distributions coming out from the fixed income side. And then what we normally do in up markets, which is most years, you move some of that extra money you earn in the stocks over to refill that fixed income bucket. Now, if you're not taking distributions, not nearly as big of a deal. We would still do the rebalancing, of course, but you just don't have all of the worries of taking money out of a portfolio that is down some due to the market, right? Okay, hopefully that makes some sense there and gives you some clarity in where that comes from. So back to the main question, should I stop or reduce my distributions? Your normal distributions within that 4% rule should be fine. Extra distributions, maybe you're taking out for extra things you want to do. It's not a bad idea to say, hey, I'm going to put that off a little bit and let things recover a little bit before I take that money out. So just kind of a tip in that area. So a couple other things while we're doing the video. First thing is, we look at what can we do when we're kind of stuck at home with this social distancing thing. Driving my wife crazy a little bit. She likes to get out and hasn't been able to go into work. Well, one of the things is, by the way, if you're not already super organized, which some people are out there, we've got an attachment in the email that you clicked on to see this video. And it's from a company called Everplans that we work with. And they have a little essential planning checklist that you can download. Just a little thing to kind of help you get all your main financial things in order and organized, which is always a good idea and doesn't tend to get done because it's the last thing on most people's list. But it's a checklist to start with, and then we can go ahead and if you want to get a login to Everplans, you can go out to everplans.com and look a little bit about what that is. Just reply to the email, send it over, and we'll get you set up on that. The big thing is to just make sure you include both if you're married, both of your emails that you'd like to use for that setup, because you both would have a login for that. The other thing I attached to the email is a pretty good article a family member sent over today from Forbes, and some of you probably have seen it on the news, but it's a possible treatment plan for the coronavirus that's shown some really promising early results. And, obviously this is a worldwide issue. There's scientists and doctors all over the world looking for, ways to cure this, to provide vaccines, to provide treatments. And, I'm forever an optimist and pretty confident that there's somebody out there that's going to come up with a great solution so that we can all get back to our regular lives and enjoy the things that we enjoy doing and not be stuck home inside all the time. So just signing off, and I hope you guys enjoyed this today and got something out of it. As always, don't hesitate. Reply with questions that you have. Other questions, we'll do videos to answer those things. One of the things that Brent in the office has talked about, and we're going to try putting together, is a little video on how quick the market moves and how just a few days out, although it feels good sometimes to get out of the market when it's as volatile as it is right now, can really destroy your long-term return. So look forward to that one in the coming days, and I hope everyone has a wonderful and safe weekend. Thank you.